Hey everyone, we need to talk about what just happened to silver today. Silver dropped $4.44. That's a 5.21% decline in a single trading session, taking the price down to $80.71 per ounce. Gold lost $200.20, falling over 4% to 46.89. But here's what mainstream media isn't telling you. This wasn't a normal correction. This wasn't profit taking. This was a forced liquidation cascade triggered by something most investors never saw coming. A series of margin requirement hikes by the CME Group that have systematically dismantled one of the most aggressive precious metals rallies in modern history. On January 7th, the CME raised silver margin requirements by 47% in a single move, from $22,000 per contract to $32,500. Then on January 30th, they raised them again. And today, February 2nd, the third increase takes effect after market close. This isn't about fundamentals changing. This is about exchange rules forcing leveraged traders out of positions, whether they want to sell or not. And if you're holding physical silver or wondering whether this crash signals the end of the bull market, what I'm about to show you will completely change how you're looking at today's price action. Let me show you what this means in actual dollars. If you were trading just 10 silver futures contracts on leverage back in early January, you needed $220,000 posted as collateral. When silver hit $110, those contracts controlled $5,500,000 in exposure. Then, January 7th happened. CME raised requirements to $32,500 per contract. Suddenly, you need $325,000. That's an extra $105,000 you don't have sitting in cash. So you close half your position. That's forced selling, not because fundamentals changed, but because the exchange changed the rules. Now multiply that across thousands of traders. That created Friday's historic 30% crash. Silver went from 119 to 74 in hours, the worst drop since March 1980. And today's third margin hike means another liquidation wave is coming. The contrast? Those holding physical silver bought at $30, $40, even $60 over the past year. They're still up 100 to 200% with zero margin calls. China's central bank bought gold for 14 straight months. JP Morgan issued a $6,300 gold target 8 hours ago. Smart money isn't panicking. They're watching speculators get flushed while the structural deficit remains intact. This goes deeper than what you're seeing on the surface. Three things just collided to create this crash. First, CME implemented a new margin framework in January. They shifted to percentage-based requirements, 9% of contract value. At $30 silver, that's manageable. At $120, it's massive capital. January 7th, they raised margins from $22,000 to $32,500 per contract, a brutal 47% increase under CME Rule 802, which lets them change margins anytime without notice. Leveraged funds faced instant margin calls. They couldn't post cash. They sold. Silver dropped 3.3% to $79.78 on January 8th. Second, Trump nominated Kevin Warsh as Fed chairman on January 30th. Markets saw this as a hawkish Fed willing to keep rates high. The dollar surged 10%, but more importantly, it killed the dollar debasement trade. Investors had piled into precious metals betting on currency weakness. Warsh represents the opposite, price stability over easy money. Within hours, silver plunged 31.4%, gold fell 10%. The market repriced the entire thesis based on one policy appointment. Third, this hit at peak speculation. Silver rallied 71% in January alone, $46 to $121. That's parabolic. CFTC data showed speculative longs at multi-year highs, massive leveraged bets on continued upside. When margin requirements spike and prices fall, leveraged traders face forced liquidations that accelerate declines. Selling creates more selling. Stop losses trigger. Margin clerks liquidate. Within hours, you get moves that normally take weeks. Three catalysts. The January 7th margin hike cracked the foundation. The Warsh nomination shattered sentiment. Elevated positioning meant no cushion. The market collapsed. Here's what the data shows right now. I pulled the charts this morning. Silver tested 71.36 intraday before closing at 80.71. That's a $14 range in one session. The 200-day moving average sits around $68. If selling continues, that's the next major support. If silver holds above 68 to 70 over the next week, this becomes a capitulation low. All weak hands flushed. What remains are holders, physical buyers who understand fundamentals. But if it breaks 68, next stop is $55 to $58. That erases the entire January rally. Volume today was massive. This wasn't low liquidity flash crash. This was real forced liquidations. The RSI dropped into extreme oversold territory. Typically, that signals a bounce within days. But in liquidation events, oversold can persist. Because the selling isn't discretionary, it's mechanical. The critical level I'm watching is $75. If we reclaim that by week's end, the worst is over. If we break 68, we're looking at weeks of correction. Now the fundamentals, because this is where it gets interesting. Global silver demand hit 1.2 billion ounces in 2025, up 8%. Three sectors driving this. Solar panel production consumed 160 million ounces. Every panel needs silver for conductivity. As solar triples by 2030, that's locked in demand for decades. Electric vehicle production uses 50% more silver than traditional cars. EV production doubles by 2028. Defense and electronics, 5G, semiconductors, military systems, government-mandated price-inelastic demand. Supply side, 830 million ounces mined last year. Demand was 1.2 billion. That's a 370 million ounce structural deficit. Here's the key. 70% of silver comes as byproduct from copper and zinc mining. When those operations slow, silver supply drops. Copper prices are under pressure now. That means less silver hitting markets over the next year. China's bond yields hit 2% this week, lowest ever. That signals monetary easing. When China eases, industrial metal demand rises within 6 to 9 months. Bullish for silver. We're talking about a market with 830 million ounces of supply but 1.2 billion of demand. The gap gets filled by recycling and stocks. But stocks are finite. Eventually, price must rise to balance supply and demand. Smart money already positioned. Central banks bought 850 tons of gold in 2025. China's bank added gold 14 straight months, ending with 2,306 tons total. Gold ETF outflows were 80 tons last week, but institutions added 100 tons between 4,400 and 5,100 in mid-January. They're only down 80 tons despite this crash. Net positioning still long at higher prices. These guys aren't panicking. They're sitting tight or adding on dips. Retail, doing the opposite. Physical silver premiums collapsed. When spot crashed, retail didn't buy the dip. Sentiment is shattered. They're selling into weakness. That's the classic setup. Retail panics at bottoms. Institutions accumulate. It happened March 2020 at 1,500 gold, November 2022 at 1,650. Happening now. Rick Rule sold silver near $80 on February 1st. He said, quote, "When silver goes parabolic, I sell. When it crashes, I wait. When everyone's exhausted, I buy." Mining companies are locking forward sales at 75 to 80. They see the real supply picture. Below 70, new mine development becomes uneconomic. CFTC shows speculators cut net longs 18%. They still hold 43,000 contracts. Peak in 2011 was 60,000. We're not at extremes. Today flushed weak hands. Long-term holders who bought at 40, 50, 60 are still profitable. They're not selling. Here's what this means for you. Traditional 60-40 portfolio lost 1.8% this week. On 500,000, that's 9,000 gone. If Warsh keeps rates high, stocks drop another 5 to 8%, bonds fall 3 to 4%. Your 500,000 becomes 458. That's 42,000 lost. Those who bought silver at $40 last summer, still up 100% at 80. Physical metal, no counterparty risk, no margin calls. Institutions positioned at $38 in mid-2025, up 110% despite this carnage. The window is narrowing, not because 80 is the bottom, we might hit 70 or 60. The window matters because industrial demand is irreversible. Every solar panel removes silver permanently. IEA projects solar triples by 2030. That's 240 million more ounces locked annually regardless of price. I've tracked this market since 2008. Never seen this setup. Structural deficit that can't resolve at current prices, overlaid with speculative blow-off, creating a once-in-a-cycle entry for patient money. The question isn't whether we see more volatility. We will. Silver doesn't go from 121 to 80 without technical damage that takes weeks to repair. The real question is, are you positioned for what comes next? In every crisis, hard assets preserved purchasing power while paper failed. Silver sits at 80.71. Next critical level is 75. The 2 weeks after today determine if this was capitulation or deeper correction. I share real-time updates on social media. For exclusive research, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed advisors before investing. These are observations, not recommendations. But the data speaks. 370 million ounce deficit, 850 tons central bank buying, CME margin forced liquidations, Warsh Fed pivot, silver down 41% from highs. The pieces are on the board. The market is telling a story. All right, 3 quick things before you go. 1, drop a comment. Where are you watching from? Where's silver headed by end of February? 70, 90, back to 100? Give me your prediction. 2, if you're not subscribed, hit that button. I'm posting unfiltered analysis 3 times a week. I'm fighting copycat channels. If this added value, comment real analysis so the algorithm knows you're here for the original. 3, next video drops tomorrow. I'm covering the one indicator that predicted every silver bottom since 2008. It flashed this morning. Last time silver rallied 68% in 90 days. See you there.